So with that said, let's go ahead and move into looking at the market. We move to the downside now, and moving to the downside on Tuesday, we left a gap. And those are always frustrating. So we look at the 10-day moving average. We've gotten a little bit oversold in yesterday's trade, traded right down to the 50-day moving average. So it was a pretty good point of an opportunity to try to make a bounce back to the upside. We didn't quite touch the 10-day moving average today. We also have to be aware of moving up to fill that gap. It would be nice to come up and fill that gap before more to the downside, but it may not happen, just to leave that little bit of uncertainty in there. We still have this gap down here at 400, which looks like at some point during this type of movement, we're going to test that. We want to take a look at the DMI. As you know, I don't put quite as much weight in the DMI on a downward move as I do on the upward move, but you can see the negative directional indicator has crossed over. The ADX is immaterial because it has to have time to reset. But another thing we watch is the CCI. And you can see that we got oversold yesterday, and we bounced a little bit to the upside. So let's just kind of condense this and look a little bit historical. And that was pretty much down to a bit of a historical low. So a little bit of a bounce today was warranted, which is another reason why I wouldn't jump on anything yesterday to the downside. Let the market bounce back up. So we'll see how far we go back up on the CCI, but it's starting to look like, and we'll put volume in there. I'm sure some of you are going to ask about volume. We'll take a look at the volume with the market as well. And there was better than average volume today, which is a positive sign if you're bullish with the fact that we bounced back up on better than average volume, but still below the volume on the down days. And that's pretty normal is when things start going to the downside. Just other things to be aware of, to keep in the back of your mind that maybe this is not the best time to be going super hard to the long side. Let's be cautious. And so that's what we're doing as well. It's a great time to be putting on strangles. And so we continue each day to look for the best and best strangle positions to put on, with the fact that we're in this area where now, especially, we're between the gaps, if you will. So we have this gap down here at 400, and then we have this gap here right below where we closed on Monday. So that low of the day there at 417. So which one of these two gaps, that one or this one, is going to get filled first? But it does feel like with all of this inflation data, that's the thing that will scare the market the most. No question about it. With all the liquidity the Fed's putting in, having inflationary pressures bubble up does two things. One, that's not good for corporate profits. Number two, the Federal Reserve could, and you've heard me talk about this before, I just always take what they say with a grain of salt. Are they going to move off that and maybe raise rates sooner than they told us? Or, and this is my concern, are they actually reducing their balance sheet behind the scenes while trying to talk the market into not panicking? Because I can promise you, just watch and see, whenever the Federal Reserve officially starts contracting their balance sheet, which means withdrawing liquidity, that's not going to be a good day in the market. Now, I wanted to show you quickly charts of the interest rates, and then we'll move into looking at our portfolios. So here we have the 10-year. You can see there's been a bit of a bounce. Came back a little bit yesterday. You can see part of why yesterday was such an ugly day. Big bounce in the 10-year. And note where we are here at the 23.6% Fib corrective level on the way forward. Remember, Elliott viewed that as not really much of a correction, more of a pause in a bigger impulse move. So Elliott would not be surprised if we continue to see this turn and move back to the upside. So let's look at the 10-day moving average, and got a little bit away from it yesterday. Didn't even come back down to it today. So that could, if we move a little bit lower on rates tomorrow, lend a little bit of support. The 30-year, not much different. As you can see, a bit of a doji on the chart there. I don't know how meaningful that is. I mean, we're just a little bit above the 10-day moving average there. But the fact that we're getting hot inflationary data, interest rates are starting to show a little sign of life, that none of those things are good for the market as well. So just more and more of those storm clouds building, just to continue with the analogy that we kind of got started on our SPY updates. I also thought I would show you chart of the US dollar, which was pretty beaten up through the month of April, and right at where you thought or you might think it would find support, because you can see all these times it came down and touched 90. It bounced from there as well, and certainly interest rates going up is going to be supportive of the dollar. So when we look at the 10-day moving average here on the dollar, you can see we recovered the 10-day moving average yesterday, kind of a doji there today, which means tomorrow could be very interesting for the dollar. So if you like these recordings, I'd like to invite you to join our new Trade Finder Live, where each and every week we do a live webinar where we talk about the market, but we also go a little more in depth into the technical analysis system that we utilize to forecast where the market's likely going to go, and also to identify trading opportunities. Get your free subscription today. Take care, everybody.